Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
Okay, so just before we dive into the presentation, just want to, some of you will notice we have two logos. I've spoke to some of you independently, and some of you know that we were now affiliating with Moneco Advisors. This decision came when Paul and I had a conversation, we want to say about 1.5 years ago, about, how we wanted to go forward. Did we want to acquire companies and get bigger? Which was definitely an option from our perspective, but we knew it was time to scale because for many of you who may know, the SEC is getting more challenging. There's more layers of cost on top of that that's coming down the pike. So what we decided to do was open it up to either be an acquirer or affiliate with a larger organization that maintains each affiliation separately. So Willow remains the DBA now of Moneco. It used to be the DBA of ADCM. So nothing is going to change for you in terms of the team. We're all still here. That's the most important thing. We're all still here. The beautiful thing from both Paul and my perspective is we don't have to deal with compliance anymore. So that literally opens up, and he's laughing because he knows
it takes so much time.
It's such a relief, and from
yeah,
our perspective,
it allows us to really focus on what we love, and that's
what we love,
to our clients and doing the investments, getting into the economic stuff.
Exactly. Like from our perspective, when we sat down and we talked about this, and we could have acquired, there's no question we could have done that. And that would have taken us some bandwidth away from, again, the things that we love, which is to do the investments and work with you. This stuff gets us going. Okay. And I think, you'll see as we go through the presentation, we have a lot of thoughts. So, all right, Paul, and we can, if any of you have questions at the end of this, please ask as it relates to this. Okay. But nothing is required on your end. There's no fee increases. You have the same team. So all is well.
All right. So jumping right in. Starting with the risk indicators that are tried and true. We check in with these often, quite often. I tend to look at this stuff almost daily. And I know anytime I see a move, I'm like, hey, Alexandra, check this out. So CDS spreads, we've said it many times. These are a great risk measure of sort of the insurance on a company defaulting. So if you start to see this spread spike, it's saying that the insurance is more expensive. And if the insurance is more expensive, there's a reason for that. It means the likelihood of that company defaulting has increased. These are sort of aggregated indices that we're watching here: investment grade, high yield, and then emerging markets are the lines, and then an average of all of them. And what we can see is that high yield, which would be more riskier bonds or junk bonds or companies that are higher on the risk curve, are starting to accelerate upward. So this is a newer development, something that we're definitely paying attention to. These curves, again, are not at the same high they were a year ago. They're actually lower than where they were a year ago. Well, what we like to see is the rate of change, how quickly it starts to turn. That is something that we want to pay close attention to, and just the fact that it's starting to elevate.
Yeah, the slope of the curve always matters to us. And the risk measures aren't showing, like the traditional risk measures aren't showing something extreme. But we're seeing other areas, like this is one risk, this risk measure, that's CDS's. Where can you go down to the next one, Paul?
And here's the
Spreads,
bond.
like even this isn't showing like extreme risk right now. Bond spreads are this, we like this measure because it can't lie, but there are other chinks in the armor in this, in the bond side of things, on the balance sheet side of things, that are starting to, and they've been accumulating for a while. And typically we would start to see the bond spreads shift and change when things really start getting heated up in a challenge in the markets. And that's not happening yet. So I'm going to go to the next one. Okay. The yield curve, the last time we talked with you about this, this is a leading economic indicator. When it is inverted, you can see downward sloping inversion here. And what this is showing us is that typically an inverted yield curve equals a period of recession. And, you know, again, and I think at the risk of repeating ourselves, we dub this time as reverse stagflation. We do really think we are in a stagflationary environment, where we have higher price, slower growth in certain areas and not all. It's a really strange dynamic we have in the market, Paul, or in the economy. Paul, you want to add anything to that?
Sure. So the blue line is the most recent curve. This is as of yesterday. The That was the olive, I guess the olive colored line's kind of gross color. I don't know why they put that.
It's
Either way,
olive. It looks good.
that was from a month ago. And then the red line is a year ago. So you can see how this has changed over time, where short end, right, has gone up significantly and the long end has come up some. This is where the inversion is that this side over here is higher than this side. So it
Yeah.
makes it inverted.
Yeah.
And what's worth paying attention to is that, first off, that's a sign quickly of a recession, right? And then what we have happening now from a month ago to today is the long end is coming up, short end is staying flat. Everybody see that? And that's what's called a bear steepener. And that is another signal that this curve sends that would also say, yes, there is a recession. If it's not already here, it's coming.
Yeah, and we argue that to a certain degree we've already been in a recession, because when you look at, you know, the different layers of income people have, more and more people are struggling, and I think that's an absolute. And we have, you know, a period of where the labor force participation rate is less, so we have more people demanding from the system and less people paying into the system. So ultimately, that could lead to much higher tax rates. What's very interesting when you look at the slope of this curve, it doesn't pay for us to go out long term, because we're getting better rates in the short term. Now, we would extend our maturities if we thought the Fed was done. And I'm going to say this here. We were the only people that I know of in 2022 who said the Fed is not done raising interest rates. I can't tell you how many advisors I sat with over the course of the year. And I remember some specific conversations in November, December of 2022, where the advisors were saying that, oh no, they're done. And they were extending their maturities only to have their clients stuck with low interest rates. We don't ascribe to that. We don't think the Fed is done. We don't think they're done. And it's concerning from our perspective, because something Paul and I keep saying is, are they not going to, they're going to continue to raise until they break the system? Honestly, that's what it feels like to us, because why are they raising? Now, we know that this is, I think, the frustration from our perspective, and we can get into CPI. We know that where the prices are going higher is in the necessities, and there's only so much that the Fed can do with that. Only so much. So let's continue, Paul. Hopefully, is there anything you want to add to that? We're not in the same place today, so it's a little,
Yeah,
you know,
right. Coordinating. No,
he's
just
taking
that,
care of the
right.
kids.
Yeah, we have been talking for a long time that the Fed is not done. And we still don't believe that they are done, and that there's probably, I mean, they have said they might raise once more. they probably will go beyond that. But
Yeah, and it's interesting. The reason you see the market going down after the last Fed meeting is in the Fed minutes, I want to say of a 6 months ago or so, they said, Wall Street was believing that the Fed was going to, was it lower rates, or at least they were building in their projections lower rates for 2024. Fed said, no, that's not happening. Like that's not happening in 2024. And that was their latest announcement, what, about 2 weeks ago, Paul?
right,
Was it?
they have
Yeah.
the Fed dot plot, which is all the different leaders at the different Federal Reserves that say this is what we think the curve should look like down the road. It's really just an exercise in signaling more than anything else, because they change it every meeting. Right? And a few meetings ago, they had basically predicted or said that they believe they would start cutting rates either in Q4 this year or early next year. And in their last meeting, they pushed that way out.
Way up. Yep.
Most likely won't be cuts
hmm
deep into 2024.
Cool. All right, let's go
Which is what
forward
we've
here.
been saying for over a year now.
Yeah.
Yeah.
Yeah, I would say like and this is interesting because this is telling to our point when the Fed this is the performance of bonds when the Fed pauses, okay? And these dates here are all the times when can they see my pointer, Paul?
Um,
Or
no,
is
you want to just
okay,
highlight the dates? Yeah.
yeah,
Okay.
just do that for me. And oh, I have a pointer here. I think I can point.
Oh, nice.
Oh, see, I can point. Oh, this is so cool. Okay. So you can see these dates here is when the Fed was raising rates and then they went to a pause. And you can see the bond market in each of these cases went higher. Okay. Meaning yields came down. Okay. But this time, the Fed pausing, this is what happened. This is extreme. In one day, I think the long bond, which is a 30-year long bond, was up what, top 2 or 3%? I can't even
3%.
remember. Was it 3%?
3%
This is
move.
insane.
Mhm.
And okay, keep in mind, I've been in the industry since the 80s, so I never saw this. Never when the Fed went on pause. So this tells me, and I would say Paul likely agrees, that our thesis that rates aren't going to stop going higher. It's the propensity, I think the odds for them going higher are greater than them coming down.
Right. Some people like to say that bonds are smart money, or however you want to frame it. But if
because it is.
because it is, right?
Because they
And
know how to read a
generally,
balance sheet.
right,
Mhm.
if that was the case and that smart money believed that rates were in fact actually going to be cut, you wouldn't see this happening. Where the 2023, this line at the bottom here, wouldn't see this continue to go down.
Mhm.
Because if this whole sector thought that rates were going to be cut, price and performance would be doing much better. You would
Mhm.
start to see it turn and go up, but we're not seeing that. So that's another signal that says, hey, rate cuts are probably still on the table and most likely still coming. I mean,
And
rate
all
increases, not cuts, right?
Yeah, and all the reason why we will not extend our maturities because of that. This is just more evidence that to stay in the short end is the right way to go.
And
Okay, let's go.
at some point, yes, it will make sense, but today is not that time.
Yeah. All right.
All right.
Oh yeah. Well, this is just, a obvious piece of information is our national debt now is greater than our GDP.
And
You can
accelerating.
see
Right?
and
That gap is
accelerating.
widening, right?
hmm Yeah, we're definitely widening. And that's not, that alone is inflationary. Keep
Mhm.
that in mind. Okay. So that's not this isn't anything any of us did not know about, right? I mean, we all knew we were heading in this direction, I think. So we're having a
And
good
it's
time spending money.
Yeah, and it sort of seems like one of those cycles that repeats on itself and compounds as time goes on. Because think of the interest now that needs to be paid to service this as it goes
Yeah.
up and up. As interest rates are rising too, it's sort of like a double whammy.
Yeah.
So at some point, I think it was this. I think it was really recently. I just read an article that said that interest payments are going to pass or currently at $1 trillion a year or something like that. It's just insane.
That doesn't surprise me. And the thing is, there's all this, thought that we'll have to print our way out of this, which would devalue our dollar. Right now, our dollar is rallying against global currencies, primarily because we are the most aggressive right now, raising interest rates. I mean, Europe is raising, but they're nowhere near the level that we are. Right now, I think the 30-year mortgage is at 8%.
Insane.
It's insane for Paul because he hasn't been, like, I was telling him my first mortgage was at 15%. Like, so,
Yeah, I
in the
remember.
late 80s.
Right.
hmm So maybe 16%. Okay, and let's go forward from here.
Okay.
Okay. So this is to us again, like I know we're repeating this, but again, what, 5, 10 years ago, the decision was made that the only money market that cannot break the buck, the only money market the government will backstop is Treasury. Any other money market that's not in Latin government bonds will not be backstop to break the buck. In other words, $1 in, $1 out. Okay. Now, why this is a big deal. Now, let's just talk about this chart. What this shows is see that steep drop? That was after Silicon Valley. That's the amount of deposits leaving banks. Now, keep in mind, the money in banks is what they loan out for small businesses so that our economy can continue to go. Keep moving. Okay. Now, what's happening, the reason there's this, what it's called disintermediation, the reason this is happening, and we all know this, banks are, if you're lucky, you're getting 1% in your bank account. But if you move the money to a money market at a broker dealer, like the one that we have, you're close to 5% in your money market. So this is a disintermediation. So what people are doing is they're moving out of banks, making it harder for banks to make loans, okay? And moving into money markets. Most of them are moving into the Treasury because it's buck for buck, or into, government bonds. And this, to us, this speaks potential problems in the banks going forward.
Right. And remember, it's these small, local, regional banks that really are the lifeblood of sustaining our economy through generating loans to start businesses, acquire businesses, to do all the funding for and all the expenses, everything mostly comes from these banks. And so now the $1 trillion hole of funds that would otherwise be used for that purpose are now locked up in money market funds instead.
Yeah. And
What does that do
here's
to growth? Right.
Yeah. And here's the thing, and this is why we're going to say, just make sure you're under that $250,000 threshold, please. And again, if you want us to look at your bank, please let us know, because we can, look to the best of our ability, determine the soundness of the bank. The next slide that Paul is showing here is the amount of money in market inflows. This is significant. So yeah. And someone was asking me why banks were only giving 1%, like why are they so low, or even 0.50%, 50 basis points. And you have to think about it. And Paul did put a slide in here. I don't wonder if it's coming up next, Paul, on the fact that many banks have fixed mortgages. Now they all have commercial loans, which tend to be more variable, okay, that float not to LIBOR, but to SOFR now. But the fixed mortgages, I know 30-year mortgage at 3.25%. There's no incentive to sell to pay that back, right? Because now you're getting mortgages at 8%. You have to remember that person's only paying them 3.25%, and they have to borrow money at higher rates now. And they can't afford to pay you more than 50 basis points or 1% right now.
That's how they make the money on that spread.
Yeah. All right. So let's go to the next one, Paul.
Yep. This is the term funding program.
Yeah.
BTFP by the Fed, right? And we've talked about this pretty much every presentation for the past several months, because when you see the usage of these facilities increase or continue to stay elevated, it is a sign of stress in the markets that not all is well. Otherwise, these facilities would not be being used. And
So you
over
can
$1
see,
trillion is in this current one right now.
yeah, this is a liquidity program for banks, and you can see this was started just after Silicon Valley Bank or during Silicon Valley Bank. This is a new funding program, and it accelerated and leveled off. Now, what we need to see here is we need to see this go in the downward direction. I'm happy that it stayed stagnant. Okay. I don't love it, but at least Paul and I are like, okay, this isn't getting
It's not going up.
worse. Okay. If we see this shift in the upward direction, like if these bars start heading in this direction, this is when we'll say that there's more risk on again. It's already, there's risk on. Okay, let's not sugarcoat this. It's there. It's happening. But it's just not at it's leveled off for this time being. We if we see a spike here, then we'll have to get even more conservative, we would say. Okay. What do we have here?
This again speaks to the money market flows, right? Banks need to have their assets on hand so they can lend them out and create essentially the whole money creation process. We've just gone negative on this whole credit at commercial banks. And this is a percent change from a year ago. That's what this chart shows. The other time this flipped negative was after 2008, 2009.
All right, let's go forward.
Okay.
Okay, say at a time where a lot of people are putting their money in money markets and supporting the government bonds, at this time, China now is, you can see over the last several years, 5 or 6 years, their participation in the Treasury is going down. They've been a big holder, so has Japan, of our Treasuries. And if this is significant to us, primarily because if we don't have anyone demanding our treasuries, then we don't have a good funding source. So what what happens now is a lot of the banks do support treasuries, always have, but we've also had these outside countries supporting our treasuries as well. So oddly, we're going into a period, as you saw, where we have much higher debt and less participation by China. It would be interesting for us to look at Japan. I think Japan's held pretty steady, except for when they had that currency issue a few months ago.
Right. And another reason why this is so important is the feedback loops that are attached to it. So when China is selling treasuries, it puts pressure on treasury yields so that they are more attractive for people to buy. So that is also a pressure pushing up yields in the bond market. And when those yields go up, it in turn, right, puts more pressure on servicing that, and ultimately it plays into inflation too. Just with things continuing to sort of feed back onto themselves and build up over time.
All right, cool.
Not a great trend, right?
This is interesting. This is the gap between the euro and the dollar, and it's widening. And it's, again, as we said, like as when we're in a tightening environment, the dollar is going to rally against other currencies. And even though Europe has been raising, it's not at our pace. This is a really wide gap. I don't think I've ever seen it like this.
Yeah, this change is dramatic and definitely something to pay attention to. This chart's really just showing how much of each currency is used in international payments. So settling international trade, all these different things. And just the fact over less than a year, the euro has dropped from close to 40 to mid 20s.
Yeah, this is insane.
A huge change.
Crazy. All right, let's see. Leading economic indicators, just again, we're pointing out that right now, here's where we are. We're in the negative. It's ticked up a little bit over the
Now,
last,
the last
yeah,
report just started to come back
yeah,
down.
come back down. So this measures what, 8 different measurements. So yeah, let's keep looking.
Yeah,
And
here's the different components, and everything on the
mhm.
left is those that are sort of a negative draw on it. Everything on the right is a positive. In a booming economy, all of these metrics would be on the right side of this, signaling growth, signaling appreciation of stocks, building, manufacturing, consumers strong, manufacturing strong.
Yeah.
But everything's on the left, saying that these are actually detractors right now. They're negatives. They're having negative impact on the economy and markets.
Yeah, and I just have to say this was looking really good before Corona. I
Mm.
mean, I remember sitting in the conference room with Paul and saying, I don't know, 2017, like I've not seen the economy this good in so long. And it had to do with the advent of AI and robotics, like a whole new technology, just like, in the 90s, we had the internet boom, and then we started to see another ramp up in technology in the late, decade of the 2000, 2015, 16, 17, 18, 19. So yeah, that was the last time these were all on the other side of the margin. Yeah. So, and
Couple
inflation.
charts on inflation. Here's just some CPI. I tried to do two separate ones to separate food and energy just to show. I did just also read an article about orange juice is up 350% in I think a year and a half or something like that. It's wild. But
Yeah.
based on this chart, right, the price of food is still going up. Eggs sort of did this crazy thing where they went way ahead of themselves and came down significantly. It's still much higher than it was
Yeah.
right? The trend
Yeah.
is that everything here is slowly drifting up.
hmm
And it sort of, when I squint my eyes and look back, it sort of looks like that rate of change is accelerating too.
hmm I was with my a client yesterday who mentioned that the chicken farmers want to go by the way of the same way as the beef farmers, as the cattle farmers, because you can see, look at the price of of beef here. I mean, look at this.
The
A
blue
huge
line, right?
spike this year. Yeah. And so they want to like lower production so that they can have that same price spike. So anyway, just would let you
That's
know that.
wild. In less than 20 years, the price of ground chuck has increased from a little over $2 a pound to over a little over $5 a pound. That's
Mhm,
crazy.
mhm.
Um,
All right.
and then here's
And then
energy. Gasoline, as I'm sure everybody's aware, prices has continued to go up. Um, and again,
mhm,
that is going to spill over, right? So the price of gas goes up, then the price of transportation goes up, the price of food goes up, the price of shipping things around the world. It just another one of these feedback loops that sort of um, compounds on itself. Uh,
oh yeah, here we go.
here are
And the
all the
same.
different categories that contribute to the CPI number, and this sort of measures the annual change in each category. And the reason everyone was talking about, oh, inflation's over, it's coming down, was because energy had pulled back so much, and you can see that at the bottom. Those are the
Mhm.
lines.
This is where it
Energy,
was. This is
right?
where it went, and this is
Mhm.
where it is now. But we don't think that's going to last because, we're closing down pipelines and exploration and all this type of stuff. So we, and you can already see it at the pump,
Mhm.
when you're pumping your gas. I mean, it's already there. So, yeah.
Not to be, negative. I hope it's a mild winter, right? Because
Yeah, yeah, I
otherwise
do
we
too.
could see some very serious spikes and issues with energy markets. And
Yeah, yeah, definitely.
yeah, here's the mortgage chart. Talks about
Yeah, this is the
this-
one we were talking about earlier. Yep.
so because most of the US is in fixed mortgages, the effective rate, meaning that the current rate right now, if you were to sort of aggregate everything together and look at it just today, what's the average rate for the US is much lower than the rest of the world because the majority of US mortgages are in 30-year fixed rate, um, 30-year fixed rate mortgages, right? Whereas much of the rest of the world have adjustable rates, or they only lock in the rate for a year or 2 or 5 at most before they reset. And so you can see in other countries all over the world that effective rate or what they're currently experiencing is going up significantly. Another thing that puts constraints on growth, right? So
Mhm.
one of the themes, if you haven't noticed, is recession, right? These are all data points that would point to or strengthen the thesis that yes, we are in a recession, or that
Yeah,
it's
and it's interesting for those of you who remember in the financial crisis, there were so many variable mortgages, and that's where a lot of people got into a lot of trouble. Now, I think so many people learned to get a fixed mortgage, and that's definitely we're seeing that. It's definitely people have more fixed mortgages, and so the risk to the consumer in that regard is better. Oh, oil
very
reserves. We kind of
yeah.
went a little
I know these should have
flip-floppy
been
here, but
switched.
that's okay. This is a strategic oil reserve. I don't know. Some clients of mine are saying that they've seen numbers that shows we have a stockpile. Well, no. This is the strategic oil reserve. You can see we've spent it down. We're at the lowest level we've been in 40 years. This is at a time where we have a lot of political unrest.
Yeah, it's been
Yeah,
cut in half, right?
yeah,
And the idea with it being cut in half helped with the energy issue where gas prices over the summer and everything in the spring were lower,
yeah.
but at the expense of losing half of our strategic petroleum reserve. And now rates are well, gasoline prices are starting to
Way
go up,
higher than,
right?
yeah.
What do we do if this isn't an option anymore?
Yeah, I mean, I think oil is bouncing around 85 to $90 a barrel, and we didn't put the chart in here, but there are some critical levels that it has to stay at in order for it not to go back up to 110, $120 a barrel. So why this is important, strategic oil reserve is there for emergencies for the United States. We only have half of what we typically had. It was being used to push down the price of oil. Okay, at the pump, it worked in 2022. If you remember, we hit really high prices at the pump, and over that course of the summer, you saw the price at the pump come way down. So, and it continued to stay relatively low until the latter part of this summer. So this is part of the reason why Paul and I do think that we'll see higher, um, higher energy prices as we go forward through this year and through the winter. And savings.
Yeah,
Yeah, another.
excess savings. Yeah.
I don't think this is a shock to anyone in this room that, the savings rate has come down. You can see during Corona, like we hit a low in Corona and it's come up and now we're heading back down.
Oh,
And where
wrong,
are
wrong
we?
way. Okay, there
What
we go.
happened? Oh, and
There,
then credit
there we go.
cards.
Yep.
Yeah, we're living on credit cards. This really worries me. Again, yeah, I think this is hitting into different levels of the socioeconomic status now. I think it's moving up in levels from where it was. So this is a record. This is a
Yeah,
record.
and you can see, right, as excess savings deplete, credit card usage hits a new record.
Crazy, crazy,
And
crazy.
now delinquencies. This is something we did talk about a few months ago. We had a similar chart to this, and we noticed this turn and said we want to watch this because it's going up, like
Yeah.
like we predicted.
Uh,
And here it is hitting a new sort of short-term high. I mean, obviously we're not where we were back in 2007, but we'll see. Mhm.
mhm,
I don't see anything that tells me we won't get there.
mm. What do we have next?
All right, so here's
And the
credit card
interest rates.
interest rates. Right, this
That's
one's wild. The
never have a
average,
never
right,
have a balance on a credit card. Never, ever, ever, ever,
pay it off
ever,
every month,
ever,
pay it.
ever. I don't think any of our clients do.
Yeah, I know.
Mm,
I mean,
Okay,
this
what
is
about?
just what 30 something years of history,
Mm-hmm,
and so for the past, these rates have never been this high.
hmm
And why would credit card companies increase their rates? Probably
Because
because
I can.
they can, for one. Number two, their consumers will start not paying increases, so they need to make up that loss of
Mm-hmm.
funds somewhere.
Mm-hmm.
So
And what do you have next?
yes, they can. Yep.
Because they can. Yeah, small business
Yeah,
bankruptcies.
bankruptcies.
Yeah, we have a
2023 is on track to be a pretty high year for bankruptcies. And this is, again, small businesses, the lifeblood of our economy. And so when all these small businesses start going under or failing, it does not bode well for growth in the future.
Mhm. Yeah, what do we got? Nope.
Oh,
And then
markets too.
it's just this is just like as you know, Paul and I do technical, we look at technicals. We want to see the market break above that point here. If it doesn't break that point, and this is we're just talking about the broader market. If it doesn't break that point, we think the propensity for it to go lower is good. So there are certain pockets in the market that do look good, and we spoke to energy, and we are starting to see flows in energy in a pretty large way. India continues to have good flows, so it just is very dependent upon which industry we're interested in. This is so this isn't anything we haven't seen before where we have, this tick down, and this to us is a deciding factor. The market is at this inflection point. Will it rise above here, meaning from a technical perspective, it's in a healthier position, or will it roll? And this could potentially be what we call a double top, but we don't know yet. It has not formed completely.
Yeah, and I did hear this morning about if you took I think they're calling them the Magnificent Seven now, the seven largest companies, Google, Amazon, Apple, those guys. If you took them out of the S&P index, it's actually -2 or 2.5% year to date. Just wild. So those mega cap companies are really what has been holding everything up.
Mhm.
That's all I have for slides. Oh,
Okay. Oh, we did put
thought it
this one
was,
in
but
here.
there's one more. Yeah.
This is just this is just rethinking as many of you know, we're ESG SRI managers. We were officially at one point, and then because of some of the concerns that we had, that policy was getting way too far ahead of our ability to actually make it happen. And you can see, like, and keep in mind, we don't look at necessarily any of this from a political perspective. We're just looking at this from an economic perspective, okay? And from, if you say a policy's out there, are you really achieving your goals? I mean, that's really important to see this. So this is the electric car, this is the conventional car, and these are all the materials that are necessary, raw materials to go into creating this electric car. And these are all the ones raw materials that go into creating the conventional car. And you can see
It's
that
wild.
there's a
Double,
lot we
double
need
the
to take.
copper, double the manganese. I mean, and the plan is to eventually shift entire fleet of vehicles to electric vehicles. But in order to do that, you're using 2 to 3 times more minerals or raw materials that need to be extracted from the earth, need to be refined, and then need to be manufactured into these vehicles. That is a massive, um, and I've yet to see a really solid plan on how. I mean, in the short term, sure,
Yeah.
you can get there for a decent chunk of the fleet, probably, the 25% or so. But anything
Yeah. And
after
I
that,
mean,
mhm.
yeah. And we think that this kind of thing will push prices higher because
It's inflationary just by the
it's
nature
deeply.
of its design.
Mhm. Yeah. Yeah. And so this is why we look at these types of things too. So, it's like, how is this literally going to affect the economy overall? A whole infrastructure has to be built
Mhm.
for these electric cars. And where are you going to get the energy from? Because there's a gas isn't they're not allowing as much gas exploration. This isn't like saying I'm not green, I'm green. Everyone who knows me knows I live in a home that is very eco-friendly. However, I'm also concerned about all of humanity, and not everybody could afford because prices are going higher to heat their home and eat and all of this. And that ultimately leads to, one, our human family suffering, which is not okay. And B, two, civil unrest. So this is why, to us, well thought out policies, they matter economically. They matter all the way around to what we do, so, and I think Paul was speaking the other day to me about a battery facility in the Midwest
Oh my God.
that's
Yeah.
completely powered by a coal facility.
They had to reopen a coal facility in order to power a EV battery manufacturer. And it's great that they're building the batteries, but wait a second, why are we burning coal to do that? Is that the smartest way to go about it? I don't know.
Yeah. Anyway,
Did get a good question relevant to this about, can these materials be sourced from friendly countries?
exactly. And this is why, like, you have to understand, this is like, we're going to watch policy, going to watch it simply from an impact economically, because then it also impacts how we invest. It just does. So yeah, anyway, so this is
Yeah,
yeah,
and
and it's no mystery that the coal producing stocks are starting to do very well.
yeah.
So yeah.
So to answer this question of, can these materials be sourced from friendly countries? The answer is yes, but you have to also think about, in a world that is more bifurcated or more uni or multipolar instead of unilateral, where trade doesn't flow as easily. Remember, China is the largest rare earth, or has, I think, the largest share of rare earth minerals and materials all around the world. And so if our relations with them are not good, then the prices, right, of those things go up exponentially. And then we're forced to only rely on those friendly countries who could also charge a premium because of
Hmm.
that.
Hmm.
Again, this is another inflationary pressure.
Hmm. Any other questions? I'm going to just take a quick peek here, Paul.
Yeah. Oh, there, okay. 1 second, because I did get a few that
We
I
had a
can
few
move off.
that
Yep, a
wrote
few
in,
that
right?
came in. Yep. One was thoughts on long-term treasuries with the 10-year approaching 5%. Is it a good time to lock in a long-term treasury? And so
Not yet.
we touched on this.
I think we spoke to this, not yet, but do keep in mind there will come a point where it absolutely will be worth our while. No question.
And
And
then a
we're
little,
ready. Like, it'd be great if we can get something decent in the long term. We'd be very happy to lock it in.
yeah,
Yeah.
why not?
Hmm.
And then a little more open-ended question. What forms do you see investing taking in the future? What about private companies?
Well, yeah, I mean, private companies are still, um, I mean, there's a lot of funds out there that have private companies. Paul and I have seen some do really well, and we've seen some do really poorly. And
Mm.
it always, that answer to that question depends upon your very specific situation. If you need to live off of this money, if you need to create an income off of this money, then certainly private company investment, usually you're not seeing any type of yield and you're locking your money up. So we like private investment, but it has to be the right private investment. We've done some over the last few years, but it has to be the right situation. You want to add anything to that, Paul?
How do I see investing changing in the future? I mean, I can speculate on the idea that we'll probably see technology and a bunch of fintech stuff
Oh,
take a much,
yeah.
much more center role in this.
Oh, yeah.
We'll see many more different asset
Mhm.
classes or different things that typically you didn't have a way to invest in become democratized just
Mhm.
because of things like phones and the ability to click and do things. You pair that with some of the technology happening in the blockchain distributed ledger space, it's going to open up whole new avenues and new ways to approach it. I think at the end of the day, the end user probably won't experience too much different than what they're used to, but a lot of the back end and a lot of the infrastructure for these things are going to, or if they are not already under sort of a massive upheaval. that
And
is
that's what
already.
makes technology still so attractive.
Yeah.
Yeah. So,
Oh, yeah.
yeah. Any other questions come in, Paul? Oh, I
Let's
think,
see. Yeah, question on crypto in general. Um, in light of the current climate, thoughts on crypto. I mean, interestingly, not all cryptos, right? When we talk about crypto, we're really talking about um, the more established projects that have longevity, that have truly decentralized dynamics in play, not vaporware and scams. So, like the Bitcoins and Ethereums of the world, um, they have held up pretty well given given everything that's happening in the world right now. Um,
mhm. And there is utility there. There are some of them that there truly is utility. It just depends upon which ones you're looking at. And, as we always say, never put your money in these that you cannot lose, period. Because it's still in the Wild West. I mean, it's still in the phase of what we call the Wild West. But the fact of the matter is we are absolutely seeing utility, and we are seeing companies roll these out within their own, certain companies are using these. So it just depends. And so we still like that asset class, but again, knowing that every penny could be lost. So, yeah.
Yep, and this right now is sort of what I believe in the crypto space they call the crypto winter or the crypto bear market, where it's sort of nobody's talking about it or very few people are talking about it. It looks like there's, many things have failed. But when you look at those projects that do have something behind them, you can see that the development behind them is still going at full speed. You can still see that there are Fortune 500
Hmm.
companies who are investing
Hmm.
tons of resources into
Yep.
building up their infrastructure to upgrade their rails, to upgrade their own technologies, to integrate with these types of things. So
And and
still
and,
have.
and yeah, and you are seeing, like, the larger investment companies like Fidelity, like BlackRock. Fidelity has on their platform the ability to actually trade cryptocurrencies. This is something that no one would think of that would happen 5 years ago. We knew that it was going to happen. And then BlackRock and some of these other larger players are putting in, trying to get ETFs. They're trying to bring, be able to offer Bitcoin and Ethereum to the market. So, my guess is these companies know something. They have some bright people behind the scenes. So, I would only speculate that. If I'm not my usual chipper self, I feel like I'm nursing a cold over here. So,
I think you did
um,
great.
thank you, Paul. I
All right.
have a headache.
Yeah.
Anything else? Anybody has any other questions?
Well, if you do or you think of something later, you can always give us a call or shoot us an email. We love
Mm-hmm.
talking about this stuff and getting into the weeds with it. So,
Yeah, and if anybody wants to talk to us and call us about Moneco, our new affiliation, please call us.
mhm.
Again, our assurances to you is that we are still here. We are at the helm. We are running everything still. We are just from underneath a lot of the administrative work that Paul and I were pretty much done with. All
Uh,
right.
all good.
Thank you, everyone.
All right.
We'll
Thanks,
talk to
everybody.
everyone soon.
Goodbye.
Take care.